If you are an investor, a wealth manager, or, just someone who pays attention to the tectonic plates shifting beneath the financial world, you really need to understand this. The era of crypto as some fringe, retail-only curiosity, well, it's over. We have entered the age of institutional capture. In early 2026, we are not talking about small firms dipping their toes in the water anymore. We are witnessing a fundamental financial regime change, and it's being driven by trillion-dollar commitments from the very heart of the U.S. financial establishment. This is Wall Street claiming its territory.
That phrase regime change, I think it really captures the necessary sobriety of this moment, because the pivotal news, the thing that really defines January 2026 in all our sources, is the move by Morgan Stanley. I mean, this is a behemoth managing upwards of, $7.9 trillion in wealth and investment assets.
An absolutely staggering number.
It is. And they formally filed for their own proprietary spot Bitcoin, Solana, and Ethereum ETFs. This isn't them just following BlackRock or Fidelity into the space. No, this is a deep strategic decision to integrate digital assets directly into their core financial product manufacturing process.
And it sets up the most profound contrast in the market today, a contrast that really defines the high-stakes environment for you, the investor. So on one side, you have Morgan Stanley, the absolute picture of regulation and systematic wealth generation, filing these S1 forms for highly sophisticated, yield-bearing digital asset trusts.
Right. The grown-ups in the room.
Exactly. And then on the other side, we have tokens like Zerebro. Its trajectory is defined by its founder, a man named Jeffy Yu, who has a documented public history of faking his own suicide via live stream just to hype his previous crypto project.
It creates this stark, sometimes almost absurd bifurcation, doesn't it? You have regulated systematic opportunity on one end and then hyper-volatile narrative insanity on the other. Yet both of them exist within the same ecosystem now, and both are reacting to this massive influx of traditional capital.
Absolutely. So our mission for this deep dive is to unpack this dramatic January 2026 environment. We're going to explore what Wall Street's stake looks like in cold, hard numbers, what this institutional migration means for the backbone infrastructure, specifically protocols like Solana and the rebuilt Zilliqa, and then how the pure narrative plays from the highly organized Spart fight with Chiliz to the, chaotic AI-driven memes of Zerebro are navigating this new, capital-rich, but much more demanding environment.
And to do that, we've compiled a really diverse and extensive stack of sources. We're covering everything from granular TradFi integration data and current macroeconomic forecasts, all the way to deep technical assessments of protocols and detailed analysis of market sentiment engines. But the central thesis across all this material is clear. The digital asset market has moved past speculative mania. It is now operating as a systematic destination for global institutional capital, and we have to treat it that way.
Okay, let's unpack that institutional capture then, because the numbers confirming this regime change they're just staggering. This isn't speculation about future interest anymore. This is capital being deployed right now.
Right. We have to start by quantifying the scale of the inflow into the exchange-traded funds, the ETFs. In just the first 2 trading days of January 2026 alone, crypto ETFs recorded over $1.2 billion in net inflows. That sets a really astonishing pace.
That's a huge number for just 2 days. How does that compare historically to previous inflow cycles? Is this just front-loading anticipation, or are we looking at a genuine structural shift?
The sources are pretty clear that this is a structural shift, and the projections really bear that out. If that $1.2 billion pace were to sustain itself, and that's a big F, but analysts are predicting it could lead to an annualized intake of $150 billion.
$150 billion.
Yeah. And to put that into perspective for you, the total AUM of all U.S. bond funds across various asset classes is measured in the trillions, sure. But a $150 billion new annual intake into a nascent asset class like this, it fundamentally changes the market structure. It forces every single portfolio manager to pay attention.
And the speed of adoption seems to be accelerating exponentially, which suggests to me that a lot of those early challenges, client education, advisor onboarding, those have been largely solved. The total trading volume for U.S. spot crypto ETFs has now surpassed $2 trillion.
And what's truly fascinating there is the velocity of that money. It took the market over a year to accumulate the initial $1 trillion in trading volume after the first major spot BTC ETF approvals. But the second trillion, that was accumulated in a mere 8 months.
8 months? Wow.
That acceleration is just a powerful signal of deep market enthusiasm, increasing liquidity, and crucially, the expanding sophistication of the entities who are trading these products. This isn't just retail anymore.
So if we look at this capital deployment relative to the actual underlying asset, what kind of institutional footprint is Bitcoin already establishing?
The footprint is substantial and very tangible. Spot Bitcoin ETFs alone have amassed over $123.5 billion in assets under management, or AUM. Now, if we map that AUM figure against the overall market capitalization of Bitcoin, it's equivalent to about 6.6% of Bitcoin's total value.
6.6%. That feels significant.
It's a critical metric. It tells us that institutional, regulated, publicly traded products now control a non-trivial and growing percentage of the Bitcoin supply. This percentage represents managed capital that is very unlikely to participate in the kind of high volatility, retail-driven liquidations we saw in previous cycles. It's stickier money.
Okay, so we've established the massive momentum. Now let's get to the core of the story. That strategic move that signals this regime change more clearly than anything else. Morgan Stanley's decision to build, not just distribute.
Exactly. The significance of Morgan Stanley's decision to file for its own proprietary spot, Bitcoin, Solana, and Ethereum trusts. It really cannot be overstated. The S-1 filings, which were released in that first week of January 2026, they outline their intentions to launch these proprietary offerings. This transitions them from being a mere reseller of another firm's product, like a BlackRock fund, to being a manufacturer of their own high-margin investment vehicles.
And that's a huge shift. Previously, a Morgan Stanley wealth advisor might recommend a BlackRock or a Fidelity ETF to a high-net-worth client. Now they're building their own funnel. What is the deep internal rationale for the strategic pivot? Is it purely about cutting out the middleman and keeping the fees?
It is fundamentally about capturing that high-margin, sticky revenue, yes, but it's also about deep product integration. By moving from third-party distribution to building its own funds, the bank achieves two major goals. First, like you said, it captures the entire management fee internally, which, at the AUM scale Morgan Stanley operates at, is an enormous amount of money. Second, and maybe more importantly, it allows for seamless and deep integration of digital assets into its client portfolio management software and its internal compliance frameworks. They're leveraging their enormous trusted wealth management network, the core of their $7.9 trillion scale, to channel client assets directly into their own manufactured products. This is the definition of institutional self-interest and efficiency.
That's a masterclass in strategic timing and leveraging your existing market power. But there's an element here that truly innovates beyond simple price tracking, and it's the thing that I think will unlock vast amounts of conservative capital, the yield-bearing component.
This is the critical mechanism we have to focus on. We're talking about the yieldification of digital assets for traditional finance consumption. The Morgan Stanley Solana Trust, and separately the Ethereum Trust, they both incorporate a staking component. The S-1 filings confirm their plan to utilize third-party regulated custody providers to stake an undisclosed portion of the underlying assets.
Okay, so let's break that down. If I'm a high net worth client or a traditional financial advisor, and I'm used to measuring performance and basis points of income, why does a 3 to 4% yield on Solana change the entire investment conversation?
It completely reclassifies the asset. Without yield, these assets are primarily viewed as high beta growth instruments, totally dependent on capital appreciation. That makes them very hard to justify to conservative or income-focused clients. But once you introduce a passive regulated yield stream, even one as modest as the estimated 3 to 4% annual reward for the Solana Trust, you transform the asset. It becomes an income-oriented instrument. It changes the risk profile in the eyes of the portfolio manager. The asset now generates a total return comprised of both capital gains and passive income, which makes it competitive against traditional fixed income or dividend-paying equities.
That brings up a crucial question for these TradFi clients, though: risk. How do Morgan Stanley's proprietary trusts address the inherent smart contract and custody risks that come with staking? Are these segregated accounts, or are they all thrown into one big pot?
The filings indicate a reliance on highly segregated, regulated custodial staking solutions. So these are not funds that are interacting directly with open DeFi protocols out in the wild. The staking is managed by third-party institutional providers like a Coinbase custody or similar regulated entities. This minimizes smart contract exposure, and, crucially, it allows the bank to manage counterparty risk within their established compliance frameworks. So the yield is generated on-chain, but the risk management is strictly governed by TradFi protocols. This level of segregation is the precise differentiator that unlocks discretionary capital that was previously held back by custody fears.
And their influence is so huge that this move doesn't just stop at Morgan Stanley's balance sheet. It sets a massive precedent for the rest of global finance.
Oh, absolutely. Given Morgan Stanley's standing and its ability to clear all the internal compliance hurdles for this kind of product, their entry is widely expected to pave the way for other Tier 1 financial institutions. We're talking Goldman Sachs, JP Morgan, and others. They'll likely follow suit with their own proprietary offerings. This signals an institutional commitment to not just tracking crypto prices, but actively participating in the decentralized infrastructure itself. These banks are becoming massive validators and stakers, which is a structural change to the governance and security of these networks.
Okay, so that institutional migration is the backdrop to what has been, well, a somewhat chilly price action for Bitcoin lately. Let's pivot to the macro context and look at how BTC is holding up under all this new structural pressure, especially with the immense capital being funneled through the ETFs.
Yeah, Bitcoin is consolidating at altitude, which is actually a surprisingly resilient theme right now. In early January 2026, BTC pulled back toward the $92,000 area after failing to decisively break that strong resistance clustered near 94.5 to 95,000. It actually ended a 5-day winning streak at that level. So as of mid-January, prices are really locked in this tight, volatile channel, fluctuating between that firm $94,500 resistance and a pretty resilient support zone near $89,200.
What's truly notable here is the immediate divergence from U.S. equities during this consolidation. While Bitcoin was struggling to break 95K, U.S. stocks were hitting fresh record highs. The Nasdaq was up 0.4%, the S&P 500 up 0.3%. If Bitcoin is truly a risk asset, shouldn't it be synchronizing with that overall risk-on move?
That divergence is the crucial data point that suggests a maturing narrative. It indicates a temporary divergence in capital consensus at these price levels. See, the capital flowing so strongly into U.S. equities is still driven by robust market expectations of further Federal Reserve rate cuts throughout 2026. That improves corporate earnings outlooks and fuels tech growth. Bitcoin, however, isn't immediately synchronizing with that move. Why? Because the institutional money flowing in via the ETFs is treating it differently. They are long-duration buyers. They're not chasing immediate momentum. Crypto is in a necessary phase of gathering momentum for its own breakout, decoupled from the immediate FOMO cycle of the S&P.
Speaking of momentum, or maybe the lack of it right now, what does the technical outlook show? Are there risks looming despite the massive ETF inflows that could trigger a shakeout?
Yes, the primary risk is tied to leverage, specifically crowded long positioning in the derivatives market. Analysts are warning that open interest, that's the total number of outstanding futures or options contracts, is nearing 700,000 BTC. And persistently positive funding rates on exchanges signal that traders are paying a premium to hold these long positions. This really increases the risk of a sharp downside volatility spike, what they call a long squeeze, if that key $89,200 support level fails.
So even as the big institutions are buying spot in bulk, the speculative leverage market is building up fragility right underneath the surface.
Precisely. And critically, despite this bullish long positioning, Bitcoin's skew remains negative. This is a pattern driven by systematic overriding and hedging from sophisticated entities who are now treating Bitcoin as a treasury asset. They are buying calls to express upside views, but they're simultaneously selling puts as a cost-efficient way to fund their overall strategies. It suggests a cautious, systematic optimism rather than euphoric retail bidding.
This technical caution brings us directly to the evolution of the narrative moving Bitcoin from digital gold against inflation, which was the 2021 thesis, to something more geopolitical and strategic.
The narrative shift is profound, and it's what enables these institutional players to justify massive allocations. Bitcoin is now increasingly seen as a geopolitical hedge. It's less tied to central banks and immediate CPI prints, and far more tied to statecraft and long-term strategic positioning. This new framework is defined by analysts calling it the sovereign put.
The sovereign put, that's a complex concept borrowed from derivatives trading. Can you unpack that for us? How does governmental action put a floor under the value of a decentralized digital asset?
It refers to the idea that governmental or state-level action will ultimately place a floor, or a put, beneath the asset's valuation, similar to how central banks used to intervene in financial markets. Specifically, analysts suggest that U.S. legislation moving toward institutionalizing a strategic Bitcoin reserve. meaning active, authorized fiscal procurement of BTC by the government for reserve purposes, beyond just holding seized assets, that this will fundamentally change the asset's risk classification.
So the U.S. government acquiring Bitcoin not as confiscated goods, but as a strategic reserve asset, similar to how it holds oil or gold. How does that make BTC align with strategic metals?
It grants Bitcoin a strategic asset premium. Once an asset is deemed essential for national security or economic statecraft, its value is underpinned by that strategic status, regardless of short-term market fluctuations. The political motivation here is control over scarcity. In an increasingly fragmented global environment, having a decentralized, easily transferable reserve asset that is outside the traditional banking system becomes a strategic necessity for managing geopolitical risk. This is the definition of a long-duration treasury asset, similar to gold or increasingly industrial metals.
That explains why our sources spend so much time discussing traditional commodities alongside Bitcoin. Gold and copper have had huge rallies, and they're often driven by sovereign accumulation.
They absolutely dominated 2025 and are continuing that momentum right into 2026. Gold is trading toward that major psychological milestone of $3,000 per ounce, which is not driven by U.S. inflation concerns, but by persistent central bank demand for reserve diversification. We're talking large-scale de-dollarization efforts by sovereign wealth funds. The accumulation is systematic and it's ongoing.
And copper is signaling something critical about the technological future, especially relating to AI and the energy transition, correct?
Yes. Copper breaking $6 per ounce for the first time ever is a huge structural indicator. Its price is reflecting rigid, unavoidable industrial demand. We often forget the physical reality behind the digital world. The global expansion of AI data centers requires astronomical amounts of physical copper for wiring, for cooling, for power infrastructure. Likewise, the energy transition, with its need for massive solar and wind farms and expanded grids, relies entirely on this metal. This creates a commodity control narrative where geopolitical actors realize that controlling supply chains and accumulating strategic reserves like copper gives them significant economic leverage. Bitcoin, under this sovereign put thesis, slots right into this portfolio of strategic, non-fiat, long-term state assets.
So despite the current macro heat versus crypto chill dynamic, with U.S. equities bullish while crypto is consolidating, the long-term structural factors underpinning Bitcoin's value are now deeper than simple cyclical risk-on moves.
The structural factors are overwhelmingly strong, and you have that powerful historical anchor. Bitcoin has never posted back-to-back losing years. It's always followed the market slumps in 2014, 2018, and 2022 with a positive year. And given that Bitcoin posted a modest 6% loss in 2025 following the previous peak, if that pattern holds, 2026 could be shaped up as a strong year of recovery and growth.
What are analysts targeting if these institutional inflows continue and the macro picture improves?
The consensus is positioning for a significant mid-year move. Provided that ETF flows remain robust and the anticipated Federal Reserve interest rate cuts materialize as expected in late Q1 or early Q2, some analysts are targeting $135,000 to $150,000 mid-year. But this prediction is contingent on breaking that current $95,000 resistance with real conviction, fueled by sustained institutional volume.
That gives us a really clear picture of the foundational asset. Now let's talk infrastructure. If the capital, BTC, is consolidating and waiting for a macro breakout, where is the institutional money moving while it waits? The sources suggest it's all about building out the high-performance rails that can handle Wall Street's scale. Let's talk about Solana.
Solana has absolutely solidified its position as the preeminent high-performance blockchain for institutional applications in 2026. No question. The institutional rotation is palpable. You can see it in the immediate flow data. $32.8 million shifted into SOL products in the second week of January 2026 alone. And what's crucial is that this was happening even as Bitcoin and Ethereum saw massive outflows in the same period. This positions SOL as a key tactical infrastructure-oriented play during macro uncertainty. Institutions are buying the rails while the primary asset consolidates.
That capital rotation suggests institutions aren't just buying SOL for speculative gains, they're betting on its technical moat and its reliability. What are the key engineering developments driving this rapid move toward institutional-grade reliability?
The focus is on solving two specific historical pain points: throughput and finality speed. The first major technological leap is the FireDancer validator client, which was developed by Jump Crypto. This is a third-party client designed not just to process more transactions, but to fundamentally optimize the network's resource management.
1 million transactions per second, 1M plus TPS. That's the theoretical ceiling the sources cite. For the listener who doesn't track TPS daily, what does that level of speed unlock for corporate users that, say, 50,000 TPS couldn't? What is the use case that opens up?
That speed ceiling transforms the network. It goes from a platform for decentralized consumer apps into a viable settlement layer for high-frequency trading and massive real-world asset tokenization. Imagine running a full decentralized exchange or an entire securities exchange directly on-chain. That requires microsecond synchronization and extremely low latency. 50,000 TPS, while fast, can still face congestion under peak retail load. 1 million plus TPS, in theory, eliminates that congestion risk entirely. And that's essential for regulated entities who cannot tolerate transaction failure or unexpected gas spikes. It signals reliability and redundancy.
Okay, so that addresses throughput. What about transaction speed itself, or finality, which is so crucial for financial transactions to be considered settled?
That's where the upcoming Alpenglow upgrade comes in. It's scheduled for the first half of 2026, and Alpenglow is targeting 150 milliseconds for transaction finality. To give you some context, most legacy financial systems, and even older blockchain systems, operate with finality times measured in multiple seconds, sometimes 10 or 15 seconds. 150 milliseconds is about 80 times faster than many of those previous systems.
That level of speed starts competing with fiber optic trading lines. How does Alpenglow even achieve that specific speed jump? What's the tech?
It focuses on optimizing the communication protocol between the validators, ensuring that once a transaction is proposed, the consensus is reached and locked almost instantaneously across the entire global network. These combined efforts, FireDancer for throughput, Alpenglow for finality, are creating a technical moat that is making it incredibly difficult for rivals to lure liquidity and institutional partners away from Solana.
And we are seeing that confidence in the form of real-world corporate commitments to securing the network, proving that it's more than just a tech demo.
We absolutely are. The example of Sharp's technology is highly illustrative here. They staked 2 million SOL, which is approximately $290 million worth of the asset via the Coinbase validator. This is not a speculative retail user. This demonstrates a massive corporate treasury commitment. They are using their balance sheet capital to secure the network, proving that Solana is moving past the decentralized application layer and is now viewed as a core, utility-grade infrastructure layer for corporate treasuries looking for institutional-grade staking and settlement rails.
Okay, so let's switch gears to another network that has undergone a massive foundational overhaul to compete in this highly technical institutional environment. Zilliqa. If Solana is the CPing, Zilliqa seems to be positioning itself as the modular king.
Zilliqa is a really fascinating case study in complete structural revitalization, and it's all specifically targeting institutional relevance. They completed their Zilliqa 2.0 migration back in June of 2025. This wasn't just a minor patch. It was a full transition from a complex hybrid system to a Rust-native proof-of-stake architecture. This overhaul was absolutely necessary to address historical issues they had related to slow block finality and developer complexity, which were major blockers for regulated finance.
What was the tangible, measurable scalability leap they achieved by moving to this Zilliqa 2.0 system?
The efficiency improvement is dramatic, and it really comes down to their new consensus algorithm, which is called pipeline fast hot stuff. Block finality is now approximately 1.3 to 2 seconds, which is a massive efficiency gain compared to their previous, somewhat cumbersome 30-second block times.
Let me play devil's advocate for a second. 1.3 to 2 seconds is incredibly fast compared to 30 seconds, but Solana is promising 150 milliseconds. Where does Zilliqa's 2-second finality put them competitively?
That's a really useful distinction to make. Zilliqa's 1.3 to 2 seconds puts them firmly on par with strong, established institutional competitors like Avalanche or Near Protocol. They're all targeting that institutional settlement layer. While Solana is aiming for high-frequency trading speed, Zilliqa's focus is more on the requirements for regulated RWA tokenization. When you're dealing with something like real estate or digitized private equity, that 2-second finality is the crucial difference between a viable, efficient product and a total non-starter. It's reliable speed, designed for regulated execution, not pure velocity.
And their modular architecture, this X-shards concept, how does that specifically position ZIL for attracting regulated DeFi and institutional real-world asset projects? This seems to be the key to their institutional play.
The X-shards concept is Zilliqa's innovation for true modular scaling and, critically, for regulatory flexibility. These are sovereign, application-specific chains. For an institutional client, what's so crucial is the ability to customize the parameters.
For example, they can customize gas fees, privacy settings, and even the validator sets that are responsible for confirming transactions.
Why does customizing the validator set matter to a Morgan Stanley or a Goldman Sachs?
Because compliance is absolutely non-negotiable. If you are tokenizing a regulated asset, let's say a $500 million tranche of private credit, you cannot have unknown anonymous validators processing those transactions. It's a non-starter. Xshards allows an institution to mandate a closed or permissioned validator set comprised only of pre-vetted KYC-compliant financial institutions. This ability to create a tailored, compliant environment for RWA tokenization is highly attractive, and it moves Zilliqa beyond the constraints of a public network and into the private enterprise space.
And the community seems to be confident in this direction too, if you look at the staking data, which is always a key metric for network health.
Absolutely. The Zilliqa team actively worked to increase staker liquidity and capital efficiency by reducing the unstaking period from a long 14 days down to just 7 days. That was via an update in late 2025. This change, coupled with the clearer security updates under Zilliqa 2.0, has been remarkably effective. Over 60% of all staked ZIL has already migrated to the new staking portal, signaling strong community and validator confidence in this ambitious roadmap. They are voting with their capital, and they're agreeing that Zilliqa 2.0 is the platform to compete for those institutional RWA mandates.
Okay, so we have the foundational layer of Bitcoin consolidating, and we have the essential infrastructure layers of Solana and Zilliqa competing for these big institutional mandates. Now, let's pivot away from infrastructure and look at the narrative frontier, starting with the compelling case of Chiliz and the SportFi pivot, which sits firmly in the utility camp.
Chiliz, or CHZ, is an incredible example of a legacy project achieving significant market resilience and reinvention. The fact that it just reclaimed its spot in the top 100 in January 2026 is highly meaningful. The sources note that the market barrier for entry to the top 100 is now approximately 3 times harder than it was back in the 2021 bull run, and that's due to the colonization of the list by stablecoins and other high-hype tokens. Chiliz, which has been around since 2018, clawed its way back through performance and strategic repositioning.
And they achieved this resilience due to something that is increasingly rare and increasingly valued by institutional eyes in the crypto market: clean tokenomics.
That's the structural core of its strength, a really important distinction. Unlike so many tokens launched in the last 18 months that suffer from massive venture capital unlock bombs, scheduled releases of billions of tokens that just flood the market. Chiliz concluded its vesting schedule way back in 2022. This means that virtually every single CHZ token currently on the market represents settled value.
Why is the absence of these unlock bombs so significant to an institutional investor who's looking at the asset?
Because it removes an enormous, non-fundamental, systemic risk. An institutional investor needs to be able to project supply schedules to estimate dilution and price action. When you have billions of tokens held by early investors or VCs with a near-zero cost basis, those tokens represent a constant threat of predatory liquidation. Chiliz eliminates that systemic overhang, which fosters stability and confidence. It aligns their market structure with traditional publicly traded assets where the supply is much more predictable.
The focus has clearly shifted from simple fan engagement, which was the initial model of buying team fan tokens, to a much more ambitious plan, the 2030 SportFi strategy.
Yes, the vision is transitioning the protocol into a comprehensive SportFi layer. The ambition goes far beyond just fan voting rights. It's moving toward the tokenization of professional sports team equity real-world assets of a different flavor. The goal is to allow the CHZ token to capture the direct financial value of global sports franchises. This transforms the token from a collectible or a governance voting right into a sophisticated investment vehicle with intrinsic value tied to massive global revenue-generating businesses.
And this SportFi master plan is supported by 2 massive high-impact catalysts coming up in 2026 that could really drive capital allocation.
The first is a planned U.S. re-entry and expansion, and it's backed by a significant budget, between $50 and $100 million. They are leveraging the improved regulatory climate in the U.S. and building on prior successful deals with NBA and MLS clubs. The U.S. market is the ultimate prize for sports monetization. The second, and arguably more powerful catalyst, is the FIFA World Cup, scheduled for June-July 2026, hosted right here in North America.
And the sources noted a massive historical correlation here.
They did. Historically, the 2022 World Cup drove a staggering 380% rally for CHZ. Major global sporting events drive adoption, fan engagement, and trading volume. And that positions CHZ as the de facto currency of the sporting economy during these peak periods. The combination of clean tokenomics, a clear RWA utility pivot, and these massive global catalysts makes this a very high-conviction narrative play.
Okay, so let's pivot from high conviction utility to the polar opposite end of the spectrum, which brings us right back to the dichotomy we started with, Zerebro. This is pure AI-driven narrative and, frankly, some of the most dramatic and ethically challenging content we've seen in the sources.
Zerebro truly exemplifies the hyper-speculative edge of the market where technology is weaponized for narrative creation. Zerebro is defined as an autonomous AI system that generates hyperstitional content. This means it creates stories, articles, and cultural events that deliberately blur the line between fiction and reality. It uses something called retrieval augmented generation, or RAG, to drive market narratives across multiple chains like Solana, Polygon, and even Bitcoin.
So, if I understand RAG correctly, it's not just generating pure fiction out of thin air. It's feeding the AI vast amounts of real-world data and then asking it to generate plausible-sounding, reality-bending scenarios that influence cultural perception, which in turn influences market sentiment.
That's exactly right. The goal is cultural engineering, autonomously creating and spreading unpredictable stories to shape cultural and financial trends. The token, Zerebro, is the mechanism through which the market bets on the success of these generated narratives. But this is where the human element, specifically the founder, Jeffy Yu, introduces the extreme, almost unbelievable controversy.
I mean, the founder faked his own suicide. That's not just market manipulation. That's performance art taken to an illegal and disturbing extreme. How did the sources handle reporting on something that extreme? Did they treat it as market data or simply criminal activity?
It was treated as highly impactful market data that severely undermined trust. The founder, Jeffy Yu, gained prominence through Zerebro, and the token peaked at nearly $785 million in January of 2025. However, he is now infamously known for previously faking his own suicide via livestream in May of 2025 to promote an earlier project called Legacoin. That event was explicitly framed by Yu as his final art piece designed to maximize market impact through shock. The sources used the term pseudoside exit. That level of theatrical manipulation must absolutely destroy whatever institutional trust the Zerebro ecosystem might have built. It shattered it. The founder's antics have severely eroded institutional confidence, and they contributed directly to the Zerebro's dramatic market collapse, a stunning 92% decline from its January 2025 peak. The token now suffers from thin liquidity, historical manipulation fears, and the resulting consequence. Delistings from numerous platforms like XMO in December 2025, which saw the project as too high risk and reputationally damaging.
Yet, despite this high-risk history, Yu is doubling down. He's launching a new Solana-based meme coin, PLOI, and it's accompanied by an AI-authored manifesto. This suggests they are treating this entire market cycle as a conceptual art project.
They absolutely are. The new PLOI token launch came with a manifesto titled Physical Limits of Intelligence. This document, which Yu confirmed was entirely authored by the Zerebro AI system, is deep and philosophical. It posits a future of biological, chemical, and even surgical human-AI convergence, and it challenges the idea of a standalone AI superintelligence. This philosophical background is meant to serve as the conceptual anchor for the project, positioning Zerebro and PLOI as bridges between conceptual art, emerging technology, and high-risk crypto.
So how is the token performing amidst all this philosophical and dramatic intensity? Is narrative and founder drama enough to sustain value?
It remains extremely volatile, and the consensus is pretty bearish. Although Zerebro has seen short-term pumps like 12 to 15% intraday gains on Binance futures this month, these lack any fundamental triggers. The token is currently trading over 93% below its January 2025 all-time high. The volatility largely aligns with momentum trading and thin liquidity, which makes it, as one source notes, a retail casino driven by short-term speculation rather than a serious institutional player. It's the ultimate contrast. Morgan Stanley selling predictable yield on Solana, and Zerebro selling AI-authored transhumanist philosophy packaged with founder drama.
That dichotomy perfectly encapsulates the maturity and the simultaneous absurdity of the digital asset market in 2026.
It really does.
Yeah.
But none of this institutional integration, not the Morgan Stanley Trust, not the Zilliqa RWA play, not the expansion of the ETFs, none of it could happen without the necessary ingredient of regulatory evolution. So let's turn now to the U.S. policy pivot of 2026.
Right. The U.S. regulatory landscape has fundamentally shifted, moving toward legislative clarity and institutional enablement. This is what's allowing that trillion-dollar capital to even start moving.
This shift is palpable. We are moving away from the years of regulation by enforcement, where the SEC and other bodies set policy by suing firms, and moving to a framework of legislative clarity. This environment is largely attributed to landmark legislation passed in 2025 and a generally more industry-friendly approach from key regulatory bodies seeking to secure U.S. financial dominance in this new sector.
We have to start with the Genius Act, which clarified the stablecoin landscape. Stability is absolutely crucial for institutional settlement.
The Guiding and Establishing National Innovation for U.S. Stablecoins Act, or Genius Act of 2025, provided that long-awaited federal framework for payment stablecoins. This is essential for the TradFi movement into the space. Under this law, stablecoin issuers must now maintain one-to-one reserves in U.S. currency or highly liquid assets, such as short-term treasury bills.
And what about accountability and transparency?
Crucially, the law mandates monthly public disclosures detailing their reserves, which brings transparency and reliability to the entire stablecoin market. This effectively integrates stablecoin growth into the broader banking system and the U.S. Treasury market, ensuring that the rails for digital dollar transfer are compliant and robust.
That clarity is essential for institutional confidence. But what about defining which tokens are securities and which are commodities? That jurisdictional tug-of-war between the SEC and the CFTC has been ongoing for years, and it prevents long-term product planning.
That is the entire focus of the Clarity Act, the Digital Asset Market Clarity Act. Now, it has been stalled in the Senate, but the markup is set for late January 2026. The bill aims to formally define when specific tokens are securities and when they fall under the commodity bucket, replacing the previous administration's more ambiguous case-by-case approach.
What are the primary hurdles that have prevented this crucial bill from finally getting passed?
There are still some political disagreements, particularly concerning DeFi oversight and the fear of deposit flight from traditional banks. Bank lobbyists, for instance, are pushing hard to prevent crypto exchanges from paying interest on stablecoins. They view this interest-bearing stablecoin product as a direct threat. They fear that regulated interest will draw away massive deposit bases from traditional banking systems. So the devil is really in the details of the DeFi regulatory framework within that bill.
So clarity is close, but not entirely finalized yet. Beyond the bills, there are massive structural changes coming to market settlement. I'm referring to the Depository Trust and Clearing Corporation, the DTC, which underpins all of U.S. securities settlement.
The DTC tokenization pilot in the first half of 2026 is perhaps the single most significant structural change for traditional finance. The DTC will be tokenizing highly traditional assets. We're talking S&P 500 and Russell 1000 securities on approved private blockchains. This is the ultimate integration of the 24/7 crypto rails with traditional finance settlement.
So if the DTC, which settles trillions of dollars in securities every single day, moves to this system, what does it mean for the traditional T+1 settlement cycles we're used to?
It means the eventual collapse of those antiquated cycles. It bridges the gap between the speed of digital assets and traditional finance. It proves that the crypto rails are not just for niche assets. They can underpin all global commerce, offering near instantaneous settlement for the most massive financial instruments in the world. It's a quiet but revolutionary development that legitimizes the underlying blockchain technology for Wall Street use.
And finally, the IRS is ensuring that the rules of compliance are becoming operationalized for every investor, closing the loophole of anonymous trading.
Yes. For the 2025 tax year, brokers must now report digital asset sales using the new IRS Form 1099-DA. Now, while this provides a much clearer reporting framework for compliance for standard buy and sell trades, we do have to note that significant gaps still remain, specifically concerning cost basis tracking for complicated DeFi activities like yield farming, borrowing, or certain staking reward claims. The hard work of turning policy into meaningful granular compliance for every retail user is really just beginning in 2026.
This has been a fascinating deep dive covering the massive scope of the January 2026 market. Let's just try and synthesize the dominant themes here.
The overriding theme is that institutional migration is now the primary driver of adoption, period. This is being executed via regulated structures like ETFs, evidenced by that pivotal Morgan Stanley filing, and through innovative yield capture mechanisms like staking trusts that make digital assets palatable for conservative, income-focused capital.
Right. And for the underlying infrastructure, technical excellence has become non-negotiable. The protocols that have undergone these step changes, Solana with its FireDancer throughput goals and Alpenglow finality, and Zilliqa with its 2.0 Rust overhaul and regulated X shards, those are the ones attracting this institutional money because they offer true reliability and speed under compliant frameworks.
Absolutely. The market is increasingly defined by the ability to connect genuine, quantifiable utility, like the SportFi equity pivot of Chile's, with its clean tokenomics, with clear, regulated infrastructure. And this creates a very clear dichotomy for investors.
A dichotomy that you really have to acknowledge to succeed in 2026. On one side, you have regulated, yield-focused opportunities, the new income vehicles being offered by Wall Street. And on the other, you have high-beta, narrative-driven risks personified by the thin liquidity and historical manipulation fears surrounding tokens like Zerebro. That separation between a systematic asset and a speculative art project is absolutely key.
It brings us back one final time to the role of AI in all of this. We are seeing AI used to optimize financial operations and generate passive yield rewards on institutional ETFs through optimized staking, giving Morgan Stanley an edge. And at the same time, we are seeing autonomous AI systems author manifestos and generate hyperstitional content to promote highly speculative meme coins, driving retail sentiment.
The Physical Limits of Intelligence Manifesto, written entirely by an AI, discusses human-AI biological convergence, and its value is tied directly to a token's market cap. We also know that the major financial institutions are integrating AI into their core operations to model risk and create yield.
So we have to challenge you, the listener, with this final provocative thought for your own exploration. If the ultimate financial revolution is not just one of underlying technology, but one of narrative and sentiment control, what happens when both market sentiment and core financial narratives are autonomously generated by AI? Is the true power broker the institution deploying AI for yield optimization, or is it the autonomous hyperstitional engines of the meme economy? And more importantly, once AI is fully integrated on both sides of that divide, will we as human investors even be able to tell the difference between the two?